Siva, and thanks for this opportunity. Good morning, good afternoon, guys. I hope everyone is safe and sound wherever they are. So thanks for this opportunity. Maybe I'll just touch upon brief on our process systems and this, and maybe we'll take with some uh, examples, and then maybe happy to answer any questions for India if you may have. So clearly, friends, sorry, yeah, Shiva.
Yeah, I was going to ask, do you want me to share the presentation?
No, it's okay. I have on my desk. I'm sure everyone would be having it, right? So, yeah.
Yeah,
So fine.
awesome.
I'll just touch on brief and then maybe happy to have more two-way discussion. So at least I understand where we are standing. Uh, so friends, clearly, if you look at India, first and foremost, you have to look at India with a bottom-up stock market thinking. We are not like China, which is a top-down approach. We are more bottom-up players in the market, and India has been able to bring in many winners over last many years in different sectors. And as you would appreciate, India is all about entrepreneurship. There are close to 20 to 30 million entrepreneurs, large, mid, small SMEs, mid SMEs, who have been thriving this market. The business of the government to run any company has shrunk significantly, and this is across the sectors. So hence, India offers large opportunity on the bottom up side of the market, where you will have a lot many entrepreneurs becoming bigger and bigger over a period of time, and that is all about India. Last 11 years in Axis, we have been just trying to understand the best winners in a particular sector, and so far it has been to our advantage. Obviously, we would have made mistakes in identifying business models or the managements, but nevertheless, it's been a great journey for Axis for identifying those winners. And frankly, as you take any data, be it mortgage to GDP ratio, credit card penetration ratio, car penetration ratio, all numbers look pretty small in the overall scheme of things, and hence India has a lot many opportunities to bring more and more entrepreneurs as they try to disrupt the business models with the advent of new technology innovation. So this is all about the way markets have been shaped up. Always there is some dichotomy between what's happening in the economy and why markets are at this level. But the simple answer is the big is becoming bigger. The innovation is helping profit pools go to a tier one, tier two companies in those sectors, and rest are in some sense trying to change their business models or trying to do mergers or consolidations to ensure they also are on the growth path. So India is all about growth. We really feel that there is lot many opportunities for companies to grow in India with nominal GDP growth rate on an average around 10 to 12% on an average. I think there are companies which can offer you 2x or 3x of nominal GDP growth. And as I said, that there are so many opportunities in terms of penetration levels. Just giving an example on the financial sector, which is a large sector in the overall market cap of India. Still, 50 to 60% of the entire India is underbanked. So that is the size and scope available for anyone who is trying to play this catch-up game in terms of gaining market share in the Indian financial sector. And I'm sure if you guys are aware that there are so many new companies, new non-bank financial companies, new private sector banks, new small private sector banks who have come up and trying to grab market share versus the public sector state-owned banks, which still account for close to 60-70% of the assets and the liability side of the market. So first is the volume growth available as GDP growth, and second is the market share gain available as you try to gain market share in that sector versus the state-owned enterprises. So it's a great opportunity. If you really see, and if you go right in assessment of the company, in understanding the business model of the company, in understanding the management of the company, then there is a clear demarcation which can be seen if you have our presentation. If you go to slide 3, you will see the top quartile companies over last 10 years would have delivered 27% CAGR, whereas the index would have delivered only 14.5% CAGR, and the bottom quartile companies would have delivered negative 15% CAGR. So I think clearly quality, good sound management, scalability, innovation, and the most important part is growth as a theme for India, I think has really played out very well. And this is what we also intend to do in terms of our thought process. If you see the slide 4, what are the various ways to identify quality companies? And I think it is very simple. Look at the management pedigree. You will get the history of the management through channel checks. Once you get the comfort level on the management, you understand the transparency process of that management for the minority shareholder, and ultimately understand the company in terms of their business model, pricing power, and the ability for that company to generate high ROEs without taking significant debt on their books. So I think these are very simple metrics which we really look for, which collates both quantitative and qualitative factors, and that really helps to understand. If you go to next slide, that clearly helps to understand. If you take the bottom part, which is avoid mistakes. So the most important part, what we try to filter out in the universe while taking any company into the universe itself, just try to avoid as many mistakes as possible in the portfolio, filter irrelevant and unfit companies, and process go bottom up, not following index or peer group, because that only helps you to really focus on some of the new innovations, new themes which are coming out in the market, rather than trying to benchmark yourself with some peer group or trying to benchmark yourself with index and making a mediocre returns. And why I'm saying is, if you really see 10 years back, uh, the weightage of financials in our main index, which is Nifty 50 index, was just, I would say, 10%. But as the financialization of the economy went by, now that weightage has gone to 36 to 38% now. So if I had been trying to mimic the index, I think I would have lost out the large part of the run that happened in the Indian market. Similarly, I don't know for next 10 years what would be the theme which will play out, but our job is to identify the best possible scalable sectors and best possible scalable companies who are really winners in their businesses. So clearly, if you take the above column, we look for businesses. We are not looking for prices and trying, as I said, trying to churn the portfolio every now and then. The idea is to just ensure that uh, you don't get sucked into the momentum rally or suckers rally, if I may call, and try to do uh, everything in one portfolio. because then the focus of the team, focus of the fund manager really gets whipsawed. Our focus is to identify to have a beta of the portfolio which is a low beta, because we have seen that when going is good, obviously high beta really helps out, but when going goes bad, that beta really brings the performance down. Because for us, protection of capital is also important as protection of returns. So clearly, market has rewarded our approach successfully for last 11 years. Obviously, I should mention that there will be ups and downs given the tight philosophy what we are running, and there will be periods of underperformances when there is a high beta rally or a momentum rally or a value rally. So clearly, please keep that in mind when you are looking investing into Axis as a portfolio. So I think this is what we try to do every now and then. Our approach is very high intensity, high channel check approach. We don't depend on brokers so much. We try to do as much in-house channel checks as possible, and that is what has really helped us to give us the ability to take some big bets on some of the strong brands. What you would see now in the slide 7. These are some of the strong companies who have emerged over the last 10, 15, 20 years. And in most of the companies, we would be one of the largest domestic shareholder in that company. Obviously, we are not married to any stock. If we feel that the management is digressing from its philosophy, or if we feel the business itself is coming under pressure because of uh, disruptions, and or if we feel that the execution is not as per our expectation, we take it out from the portfolio. So idea is to go diversify across sectors, but be concentrated across the strong names where you want to put your money, and take very objective decision of taking out that stock from the portfolio if the company has not been able to live up to our expectation. Obviously, as I said, we would still make mistakes in the portfolio, but so long at least 70% of the portfolio is giving you those strong returns, we can afford to make some mistakes in just identifying some of the processes and investment themes. So if you go to slide 8, I will not dwell more into detail. You can go through, and if you have any answers, happy to it. But this is the main in 4-stage equity investment process. Uh, First, most important for us is identifying the universe. As I said, that avoiding mistakes in the portfolio happens only when you have a stock in the universe, and then the fund manager gets lured to buy those stories because of the near-term pressures. So our job is to just lay down certain parameters based on corporate governance, based on scalability of the business model, innovation, ROE, cash flows, and filter out as many irrelevant companies which don't form part of the portfolio. In this, we have tried to now inculcate ESG theme as well. However, it is a work in progress. But what we are trying to do is, at least for top 100, companies of India, we would try to now get the scoring on the ESG metrics with help in-house model developed by Axis and Schroders together. So again, further tightening of the universe to ensure the longevity of the universe and the portfolio. So first and foremost is identifying the universe. Out of 2,500 stocks listed in India, we have a universe of close to 280 to 300 stocks now. So that you can understand the kind of filtration which goes to ensure that we stay on course in terms of our philosophy and the DNA what we have established. Second is again the research, which is the most important part again, to identify a great company and assign a fair value. Obviously, we don't believe in a 12-month target price. We ideally tell our analyst to look for at least three-year kind of a fair value, so that it helps us to capture most of the uh, uh, I would say ups and downs of the business cycle. Third, if you see, is the portfolio construction. Uh, uh, Again, as I said, we are bottom up stock pickers. We really feel India offers lot many opportunities in terms of new themes, new innovations which are happening, and we go stock by stock. Obviously, we keep in mind the sector weightages, and also the sector problems which may arise because of the liquidity of that sector or the volatility of that sector. So we keep that in mind and accordingly size the stock in the portfolio properly. So portfolio construction is a fund manager's job, but obviously in sync with the best ideas coming out of research table. And fourth part, the most important part of the risk management is the portfolio monitoring. And there are various risks. There are liquidity risks. There are event-driven risks. There are. I'll just go to the slide. If you can go to slide 14, there are quality risk, liquidity risk, event risk, price risk, and we try to mitigate as best as possible. Obviously, it is not 100% foolproof, but idea is to ensure that not a single stock can take your entire portfolio down significantly. And in this, the most important part is the quality risk. I think in India, if you take last 5 years, the stocks which have destroyed wealth for the shareholders are clearly the companies where the corporate governance issues was very high. If you go to next slide, in summary, I would say uh, we are long-term, fundamental driven active managers. We look for high conviction ideas. We will not downgrade on our quality parameters whatsoever, and our research is not a technical research. Our research is fundamental research, and we really feel there is still enough room, at least in India, to do those fundamental research and try to bring out two or three hidden gems every year. As India goes to next league of GDP growth, I'm sure there will be many companies will be coming out with an IPO, initial public offer from various different sectors like education, healthcare, food delivery, and many other platforms will get listed, and that is where our idea would be to grab those companies if they are available at a decent valuation. There is always a question which I'm just preempting, that India is always expensive, and you guys are absolutely right. India remains expensive because there are two things which I feel that it has kept it like that. First is the opportunity which it gives in terms of growth, and really if India with so many problems, if it can continue to still report good growth, and if companies can deliver 2x 3x of nominal GDP growth, obviously the premiums go up. Second most important point is we are not like China, and hence there are limited companies to really participate from a long term point of view, and hence the premium for those companies keep on going up as the corporate governance issues in some of the mid cap and the small cap companies is fairly high, and hence for anyone to park their hard-earned money, it is better to put money in those 150 200 good names, or maybe 250 good names in India, rather than having a plethora of stocks in your portfolio, which eventually doesn't end up giving good risk-adjusted returns. We are not like China, that there are many companies for a particular sector. If you really go down deep in India, in a particular sector, you will find only 3 to 4 good companies where you would like to park money on a longer term basis, and that is what has happened over last many years. As I said, that big is becoming bigger, profit pools are becoming bigger, and not so great companies, or the companies which have just uh, uh, got their business act together because of the momentum, I think they are struggling. Some of the case studies which I would just like to highlight, and it has been a great run. And if you can go to Bloomberg, you can see how some of these companies have done. Uh, First is the Kotak Mahindra Bank. We are, as I said, we are one of the largest shareholder of that bank since now many years. The evolution of the bank started from a bill discounting and auto finance company to now becoming a conglomerate in the financial space. The management, Mr. Uday Kotak, uh, is now one of the well-known financial czar of India, and he has built up this organization with bunch of good professionals, with a very careful, I would say, focus on risk. So I think we like the company because the company speaks about risk first and then returns. And as you would appreciate, financial or banks is sort of a leverage play. The risk is at most of importance in a business cycle than returns. So clearly, you would have seen what happened during COVID time, or during demonetization period, when you saw massive problems arising because of this uncertainty, and then a bank which was able to manage the risk profile well, credit cost well, they have come out as a winner. So this has been one of our great compounding machines for our portfolio. The next is Bajaj Finance. If you go to next slide, 17, this is also one of the unique stories in making in India. You can call it a sort of a quasi fintech play. The company started its main journey around 2013 2012, and now it has gone to become one of the largest market cap company among the financial space. If you see the demonstration of profitability while keeping the credit cost under check, I think it's been a great journey. The company has a uniqueness in a few product categories where they have demonstrated their ability to take on the banks, especially in the consumer durable financing space, where they have mastered the art of throwing ROEs, where it was which was very difficult for banks to enter. So I think taking one innovation at a time, the
Yes.
company has been able to garner uh, a good market share in some of the key domain expertise where they are. So they have 70% market share in the consumer durable financing place, and on that they have built upon the other businesses. And you have seen how the company has been demonstrating its return on assets and return on equity while keeping the credit cost under check as best as possible. The third is Avenue Supermart. The brand name is DMart. It is sort of an Indian Walmart in making. It's a pure play on grocery segment of the overall retail landscape space. The modern retail is still very at a nascent stage in India, and the company has been through its unique business model of buying properties and then giving value proposition to its customer, has been able to grow and withstand all kinds of shocks, be it e-commerce shock or other shocks. They have been able to manage it pretty well. The company got listed in 2017, and from there on, we have been the large chunk we have added during the IPO time, and the company has already, I would say, delivered 10x returns. The beauty of this business model is again the management, excellent execution capabilities. The company started very slowly with one store in 2000, 2001, 2002, and then they perfected the art of managing that. Uh, uh, and after that, they came out with second and third store almost after 3-4 years of the first store. So I think they have gone very slow, and now that they have the advantage of cash flows, they would be throwing close to, if I'm correct, 2000 crores of free cash flow, or maybe cash flow from operations by next year. Then they would be going into a high growth trajectory in terms of opening more and more stores. Also, learning from what's happening across the world, the company, around COVID, they had already started thinking about e-commerce platform, but now they are going pretty aggressively on that. However, as you would appreciate, it is the grocery e-commerce is a very difficult business. It's a high OPEX business, and hence the company is going diligently rather than throwing money just to show the investor that we are into e-commerce space. So I think these are some of the case studies, I would say, which has really helped us build our portfolio to the best possible extent. Like this, there are many other companies who have really been compounders. We really feel that compounding machines or compounding stocks over a period of time, this genuinely distributes a lot of wealth for its investor rather than momentum stocks. And we really believe that if you invest with a 2 to 3 year view from here on, I think things hopefully are going to be good for India. However, I should add some of the risk associated with India. You would have always seen that India is always 2 steps forward, 1 step back. Also, the COVID thing, which is going around, we should hopefully, as vaccination process further accelerates, we should not see a massive second or a third wave, but that is a risk you should keep in mind. Third risk, the most important risk which we always are worried upon, is the inflation risk. And because we are large importers of commodities, especially oil, if oil goes to $100, then I think India gets into problem. Hopefully, it's a hope that we don't have that situation. The government has tried to create buffers by increasing the excise duty to ensure that even if, let's say, oil goes to $100, they have uh, sort of cushion available to reduce excise duties and manage inflation as best as possible. But in the interim, if we are in for a super commodity cycle for whatever reasons, I think I should just say that these are some of the risks apart from global risk, which you know better than me. India specific risk which you should be keeping in mind while looking at India as a investment destination. Shiva, I'm through now. Thank you very much for your time. Happy to take any questions or any concerns if you may have.
Yeah, so if anyone has questions, could you please direct it via the chat, or you could just speak up and ask the question. Jinesh, whilst they're asking or thinking about the questions that they might want to ask, um, when you're looking at emerging markets, in particular markets like China, a lot of people have invested in perhaps some of the consumer tech type names, the Tencents and the Alibabas and so on. Do you think there's what do you think is going to be the outlook for those sort of industries in India? Does it exist today, and how would you play it?
So I think if I understand your question correctly, you are pointing towards Reliance Industries because that is the only company sort of moving into those lines, I would say, with creating a business model around Geo platform, which is more of a telecom plus platform, and also getting into retail. So I think in the small scale, obviously you will have some companies on the unlisted space side which are still yet to become big in India. So, likes of Flipkarts of the world, they eventually will get listed. So, as of now, to be very frank, there are not many companies to play on those grounds from the listed space, except for Reliance. If you want to ascribe, let's say, 50% of the value to now those type of platforms.
Okay. India has got a large degree of founder ownership, so the stock market is 40% plus owned by the generally the original founders of businesses. So the success of these compounding machines that you mentioned, some of the businesses that you look at, is it the man or is it the business? What would you
So
attribute?
I think it's a mix of both. See, ultimately, when you become big, obviously you would need more professionals running the show, because the risk you run on one person also is that much high. So eventually, a company has to get into a professional mode, and we are seeing some of the company. Just an example of Asian Paints. It was a three promoter run company, but for last 10 years it has been run by the professionals. So I think a good combination of a promoter taking a back step, obviously has control on certain processes and system, but a company run by good professionals with a longer term objective is what is the best combination, I would say, available in India, because still, as you would appreciate, the affinity towards higher promoter holdings are still there for India, and they don't want to give away that wealth very easily. So, professionalism is coming, but obviously, uh, eh, uh, not all companies have gone into that mode of professionalism. But you are seeing now many top 100 companies looking for that.
And what about the perennial question that global investors always have for India is, isn't India an expensive market relative to other emerging markets? And, I can't find anything attractive there in that market relative to what I can find in other regions. How would you answer that?
Correct. No, I mean, it is a fair question, and I don't have a clear answer for it. But sitting in India, I can, as I told in my earlier comment itself, because of the not so great depth in the market of sound companies, obviously you tend to give more weightages to the companies where you are okay with the ESG metrics, you are okay with the management pedigree, you are okay with the governance of the company. And as I said in my opening comments, we are not like China, where you will have, let's say, for example, 10 avenue supermarts, and giving you more variety and choice to invest, and hence the valuations are at a I would say optimum level. Whereas in India, because it's a problem that you have only one avenue mart as of now who have really done well, succeeded, and the other have gone bankrupt, future retail which has gone bankrupt. So if anyone wants to, if let's say I want to put money in that space, I have only one company to play, to be really frank. So that distinction, and as I said that uh, the longevity of growth is still huge in India. You take any parameter, and obviously means we can argue that we always live on hope, and India is always two steps forward and one step backward. But genuinely speaking, despite so many problems, if India can continue to grow at 6-7% on a longer term trajectory, real GDP growth, just imagine if some efficiencies come into play, the trajectory of 8-9% real GDP growth plus 3-4% inflation is not gone anywhere. So we are nowhere to our potential in terms of per capita income, in terms of mortgage to GDP, in terms of penetration levels. There is huge population who middle class population who really wants to get upgraded. So I think the opportunity is always huge, and hence maybe I would say investors are ready to give some premium to wait with a 3 to 5 year view.
Okay. Thanks, Jinesh, for your time. I really appreciate it. And Access is one of the advisors to India Avenue Equity Fund, in fact, our largest advisor. So we're very thankful for your insights and the high conviction portfolio that you run for us.
Thank you. Thank you for inviting. Thank you very much.